So what items can you offset when you're refurbishing a residential property for investment purposes? What can you offset against your tax bill? Great question, answered in this video. Hi everyone, my name is Simon Mishevich from Optimised Accountants, and in this video we're going to be talking about house renovation and what you can offset against your rental income when it's incurred. And there are going to be many accountants that will get this wrong for you, and meaning that you will pay more tax than you need to. And we'll talk about that in a little while. If you're looking for a UK property tax specialist or need some advice, use that QR code and look at all of the services that we can provide to you. There is a link in the description box below as well. So you might be thinking, well, what can I offset against my rental income when I'm renovating a property? Well, don't worry. If you're not sure, even with the content of this video, then feel free to use our calculator that is online and free for you to use. There is a link in the description box below, but also there will be links throughout this video. So let's talk about the types of work that you might be incurring. First of all, there might be roof repairs. We all know that the winds in the UK can blow a few tiles off your roof. You might need to replace those. You might decide, well, actually, I'm going to go for a property, it's run down. If I rent it out, I'm not going to get the same kind of rental that I really want. I might have to discount it. I'm better to replace the bathroom, the kitchens, etc., to make sure I get the very highest rental price that I can for this property. So you replace it. Renewals and paintwork, and look at those guys. Don't they look happy right now? So they're repaint. I don't think that's true, really, is it? I mean, who does that kind of smiling when they're painting? Anyway, renewal of paintwork, again, is that something that we can offset against your rental income? You're renewing an item, a wall that's existing. You're not knocking the wall down. It's an existing wall. You're just maintaining it. Okay, so that's the key thing. But what I always like to say to people is remember the 3 R's. This actually came from HMRC, and I stole it. So thank you to HMRC for this. Repair, replace, renew. The 3 R's or the 3 Re's, depending on how you want to remember this. But repair, replace, renew. If you said it along with me, it helps you remember repair, replace, renew. All right, so with that, what items can be tax deductible? Repairs, we talked about the roof repairs. Replacement, the bathrooms, the kitchens. The renewals, we're talking about those painting and decorating items. What of those can be offset against your rental income? Good news, all of it. And this is where your accountant may say, well, it's not allowed. No. It's the first time that you're renting the property out. And actually, what HMRC legislation talks about is that the property must be in a lettable condition, not that the property has already been let. That's not what it says. The legislation, the law is really important. Is it in a lettable condition as it is currently? If it is, then it can help you to incur these items to increase your rent. That's what we're trying to remember here. We're increasing our rent by incurring these charges here. And therefore, it's a cost that is offset directly against that rental income. If you're buying a property that's not in a lettable condition, and you'll know this because of the fact that you can't get a buy-to-let mortgage, then each of those items will be capital in nature. Oh, please do note, I talked about like for like, all right? So that's really important because what we need to think about is we're going from this, okay? So this is a smallish kitchen, not too much can be really put into there. And what we're going to do is go to this. Okay, so you might take a single-let dwelling. Let's remember this. This is a single-let dwelling. And what you might do is expand that kitchen. You might go to the garden. You might take out some other rooms to include this beautiful kitchen. And it is actually quite stunning. I'd like this. But anyway, so this is a wonderful kitchen. And the idea behind it is that you're upgrading so significantly. It's no longer like for like. And that is a problem if you're doing that for tax purposes, because it's a replacement and it's now on the left-hand side, which is improvement, and it's capital in nature. So it will only help you to reduce your capital gains tax when you sell the property. The other aspects of cost, though, repairs. If you're repairing a door cabinet of that kitchen, well, that would be offset against your rental income. Renewals, if you're painting the wall of an existing wall that's not been knocked down and rebuilt, then again, that will be rental offsets against your rental income. So you really do need to categorize how these costs are going to be incurred. Keep receipts, and this is the big thing, because many people, when they sell their property, have said, "Oh, I forgot to keep the receipt." Well, if you forgot to keep the receipt at the point of offsetting against your rental income, you probably won't keep the receipt either for when you're selling that property for capital gains tax purposes. Okay, so let's quickly look at an example then of how this refurbishment activity really does help you to reduce your tax liability. In this example, we've got rental income of £20,000 for that property. We've got running costs of £8,000, which we have taken out mortgage interest costs for Section 24, by the way. So including finance, but actually excluding it for Section 24. Really good differentiator here. And then we've got repairs of £8,000, which means that basically you've got a profit of zero, which profit of zero means no tax liability. It's something that I've done many, many times over. In fact, I paid no income tax on my rental income from property for 8 years. All I did was kept on buying 1 or 2 properties per year, racking up those repair, replace, renew items, putting those receipts safely against my income, and not having to pay tax, and then potentially refinancing that property, pulling the money out, no money down deal, etc., whilst maintaining my income in the future. That is a great strategy for anyone to do, especially if they don't need the money straight away.